Welcome back. As promised, let's invite Siddhartha Khemka of Motilal Oswal Financial Services. Siddhartha, morning, and thanks so much for joining in. I want to straight away talk about the IT sector that's going to be kicking off the earnings season from next week. The expectations are high. In fact, one of the brokerage notes said that the sequential improvement that we're going to see in Q4 will be the best that we've seen in the last decade. We've got a lot of stocks to pick because this is a rising tide which is lifting all boats. But I wanted, if you had to pick one stock in the IT pack, which one would it be and why?
Yeah, good morning, Rima. Pleasure to be on the show. Yes, IT last 2 quarters we have seen strong growth, and that sets up the sector for almost a robust double-digit growth for FY22. Q4 will remain strong, and both the tier 1 as well as tier 2 companies will show strong growth. The deal wins have been pretty strong. Among the large cap or the tier 1s, we prefer Infosys and HCL Tech. Within the mid-cap space, there is an interesting company, L&T Technology Services. It is one of the largest pure-play R&D outsourcing vendors out of India, and we see LTTS as a key beneficiary of the growing tech adoption across R&D and new product development. More importantly, we see that with digital being 50% of their revenues, it would clearly benefit out of the growth that we are seeing in the digital R&D spends globally. And so that's one stock we believe that we will have an ability to deliver mid to high double-digit growth over the medium term. And we expect LTTS to lead the mid-cap IT space in terms of growth. So that's a preferred pick within the IT space that we like.
And broadly, Siddhartha, what's your view on IT? Many are, it's easy to do, but maybe it works out that way, pans out that way, we'll know. But many are going back to the template of what did well during when lockdowns happened last year. IT, of course, did very well during that period. There's no question. I mean, global growth and US growth is pretty strong, very, very strong. And these are companies which derive a large percentage of their revenues from that market. So is this space set for at least relative outperformance to the rest of the market?
Yeah, Prashant, if you look at the IT space, whether the lockdowns are there or not, we have seen pretty strong structural shift towards the digital, and that is happening globally. And that is what the pandemic or the lockdowns have done to organizations worldwide to look more at digital cloud, and that is leading to higher deal wins for the entire IT space. And we believe that that will continue both in terms of deal wins and in terms of revenue delivery. What could impact is the margins, which we had seen at record high levels. They could moderate a bit once you start getting the normalization of the work process over a medium term. But still, we believe that on a relative basis, that's one of the best preferred sectors to play the current second wave of lockdowns or pandemic that is going out in India. They are best positioned to benefit out of the work from home environment and the increasing shift towards the digital spends globally.
Let's just stay and spend 2 minutes more on IT. Rima, I mean, some opinion from brokers coming through as well. I think Jefferies is saying that IT theme should play out well.
Absolutely. So Jefferies believes that the Indian IT industry has multiple tailwinds. One of them is the second COVID wave is going to be a sentiment positive for the Indian IT sector. And they go back a year ago from April to September when India saw rising COVID cases. They said the Nifty IT index outperformed the markets by 27%. Now that again COVID cases have started to rise, they expect the Indian IT to do well. So that is one. The second COVID wave will boost the sentiment on the sector. Secondly, the growth visibility remains high as we enter into the earnings season. We've seen Accenture's numbers in the guidance. So that's point number 2. And point number 3 is that their global strategist expects an end to the USD weakness. Up until now, we've been, in 2020, we've spoken about how the dollar is weakening. But from here on, they expect the dollar to possibly strengthen, which means the rupee will weaken. That is positive for the Indian IT sector. And a 1% change in the USD INR rates can improve the EPS estimates by 2 to 3%, all things equal. So Jefferies believes the industry has multiple tailwinds, which is why it should do pretty well, Prashant.
Okay, that is IT for you. So, I mean, a bit of Siddharth agrees, and Jeffrey's also kind of saying that, well, things should be pretty well set for this space. The other is the entire metal space, steel specifically. We had JSW Steel management joining us earlier on the day, and they said that March demand has been super strong. February was strong, but March has been even stronger. April, we've seen price increases coming through as well. For about 2 or 3 months, many thought that, well, the cycle of price increases was behind us. Any thoughts here? The large steel name, Siddharth?
Yeah, Prashant, so if you look at the metal space, they have been pretty strong on back of a robust demand and some supply constraints out of China that is leading to a record high, you can say, prices. That is leading to strong margins. We have seen the domestic demand also being on high single digit, but that's pretty strong given the environment that we are in, and that is leading. And the domestic prices are still at a discount to the global prices. So there is a room for further improvement in domestic metal prices. We believe the demand could continue. The opening up plus the capex oriented budget that we had seen that could continue to improve demand. Globally, we have also seen the US new stimulus plan on the infrastructure side, 2.3 trillion spending on developing infrastructure over the next 8 years. That would keep the global demand pretty strong for raw materials for infrastructure, something like steel, and hence the metal cycle could continue pretty stronger for some time. So if you look at the preferred picks within the metal space, on the steel side, we prefer JSW Steel and Jindal Steel and Power. On the non-ferrous side, our preferred pick is Hindalco within the large cap space.
Siddharth, I was just taking a look at the consumer durable space, and in that it's Orient Electric which has underperformed its peers. So in the last 1 year, Orient Electric has rallied 69%. Compare that with a Havells which has doubled, up 117%, or even a Crompton Greaves Consumer which is up 83%. You believe Orient Electrical's underperformance is unwarranted and it looks interesting at this point?
Yeah, Rima, so if you look at the pent-up demand post the unlock, we had seen a lot of demand for the consumer durable space. And now with the onset of summer season, we are likely to see a good demand for some of the consumer durable companies, the likes of ACs and fans. So some of the companies have already run up. Our preferred pick there was Voltas. But now we see that Orient Electric, which demerged from Orient Paper in 2017, is fast emerging as a strong competitor in the electronics consumer durable space. It's the third largest player in the fan segment, and we believe it's a strong brand. And with the rising temperatures across the country, the demand for the consumer durables, especially fans, will be pretty strong. The best part is that last 2 years, FY18 to FY20, Orient's revenue has grown at about 13.5% and far outpaced that of Havells about 7 to 8% and Crompton Electrics of about 6%. So in terms of growth, they are picking up. In terms of margins, they are picking up, and they have already done capex. They have entered some of the other categories like lighting, switch gears, air coolers. So we believe that growth from here on will be much better, and the discount that it trades at is unwarranted. Hence, we believe they deserve a better valuation, and hence we like that name, Orient Electric, in the consumer durable space with a target price of 350.
Siddharth, it's a pleasure. Thank you very much for joining us and running us through what you make of the market right now. Appreciate it. We're down 357 odd points.